Hi, Mitch Irwin with Bell Bank Mortgage. Today I want to talk a little bit about using support income to qualify for a home loan, specifically child support or spousal maintenance income if someone is using that chunk of income to qualify to buy or refinance a house. There's two main rules. You have to receive it for a certain period of time. It has to continue for a certain period of time. Now, conventional, that's Fannie Mae and Freddie Mac, that makes up a lot of the loans. They got to receive it for 6 months. FHA, VA, and some of our portfolio products might only need receiving it for 3 months. So it's a little shorter time frame than a conventional loan. A lot of people still prefer a conventional loan, so you should plan for 6 months before someone is eligible, and qualified to refinance. The second part is the continuation. How long is that going to continue? It has to continue for at least 3 years from the date of the closing. So you got to receive it for 6, you still need 3. Now, where that gets dicey and the second tier rules come into play is, what are the ages of the kids? If they're 15 and 17, we can't count it because it won't continue for 3 years. If kids are, 10, 12, 14, no problem. Should be able to use all of that. It gets a little stickier, and I can go into that in a different video when kids are of different ages, say 12 and 13 and 17. Do we just use 2/3 of it? I'll go into that in a different video sometime. Today I want to talk about these durations of spousal maintenance that are usually short-term, why I recommend 4-year durations if possible. Like I said, you got to receive it from 0 to 6 months. And then 13 to 48, it would have to continue. This right here is your little window to get the loan done. So if you can take the money and divide it over 4 years instead of 3, that loan can get closed. This month of 7 through 12 becomes your window of execution. In case someone's in a lease and they don't want to buy until they're closer to that 10, 11 month mark. Maybe interest rates are up and they don't want to close it at that month 7. They need a little more longer window there. Maybe they just can't find a house in this hot housing market where they need a window that's 6 months in order to get that loan done. I call it the window of execution. People will call it something else. If you only do 3 years and 6 months, you can't get the loan closed. There's no window or time frame to get it done. The very shortest I would recommend is 3 years and 9 months, because then you get a 3-month window in there. It has to be documented by a true transfer of payment. In the olden days, that was by checks. Nowadays, it's a little bit more online, just truly a transfer on a bank account. So then we're gonna need to verify that with bank statements. Lump sums, paying the bills, no dice, they don't count. It's gotta be a true transfer from party A to party B. Party B can then go back and pay some joint bills. There's nothing wrong with that. Temporary orders do count. It doesn't always have to be a true order from the court, but you should have some type of an agreement. It should state in the divorce decree when it started. It should be, there should be, whether it's from a mediation, ICMC, whatever, the payment started at this point, that gets that clock ticking. So it doesn't have to be a full order, but I would tell you that you're always safer if it is. Then every bank will accept it, or nearly every bank, if it's a true order. If it's not, most will, but some might not. My final point is determine if it's truly needed to qualify. I hear a lot of people make a big deal about it, but our debt ratios in our automated underwriting systems go fairly high. If that support income is fairly small, a couple $100, the client might qualify without it. And then you can do whatever duration you need to get, from a common sense approach versus from a lending approach about it. So determine if it's truly needed. If it's all of their income, yeah, it's pretty important. If it's only a small part, maybe they qualify for the loan on their own income and you don't have to worry about this. Or if you get it's a short-term marriage and you're not gonna be able to squeeze out 4 years, then look at other ways, other options like a cosigner, some other things to get over that hurdle. But in short, the big bullet points are you got to receive it for a certain period of time. It has to continue for a certain period of time. It's got to be a true transfer of money, either a check or a bank statement. Don't do cash. Don't net it out, meaning it was $1,000, but they owed them $200 for hockey, so they only paid $800. Don't do that, because then now we can only use the $800. So write the check for the full amount, then do a separate check for the $200 back if you're in one of those situations. Document it, and of course work with a lender that truly understands, is it needed, number one? Number two, what's a good timeline, a reasonable expectation of when that loan can close for your refinance deadline in the divorce decree. Hope that helps. Feel free to reach out with any questions. I deal with this every single day. Thanks.